Hello, I'm Bill Wendling, a portfolio manager with Bedel Financial Consulting, and welcome to our discussion on structured notes. Structured notes are corporate debt generally issued by banks. Like most debt or bonds, structured notes do have a known maturity, but unlike most bonds, notes offer a way to lock in upside participation and maybe a combination of downside protection to go along with it. Like everything out there, not all things are good. Not all notes are good. There are some good structured notes. We felt we've used some good structured notes for our clients, but we've also seen some pretty bad structured notes where there are a lot of costs embedded into them. The terms that are offered aren't competitive, and in many cases investors don't realize the full extent of the note and what they're getting into. Because of that, there are many articles out there that are critical of structured notes, and if you were to Google structured notes, you'd find some criticism, and deservedly so. There are many brokers out there selling structured notes that have high costs embedded in them, and investors are not actually benefiting from them where they should be able to. We like to do a lot of research, we do a lot of due diligence when we recommend them, but we have seen quite a few notes where we just don't think they're appropriate and would prefer that investors stayed away from them. Structured notes really got their popularity started over in Europe, and they've been around for many years, but they're almost a part of the European investment culture over there. And in fact, you can actually go into a European post office and buy structured notes. So it's a package deal over there. They didn't really start hitting America until a few years ago, and then when we went through the financial crisis, they started getting more popularity. But a lot of people still don't have enough education to really understand what they're getting into. And that's what we're going to hope to help with here today. So I mentioned that structured notes are corporate debt. Corporate debt, a bond, its guarantee is made by the corporation. So in this case, with structured notes, you're looking at bonds that are guaranteed by banks. They're not FDIC insured typically. Sometimes there is some FDIC insurance available, but really you're looking at the bank that issues the notes being able to make good on their obligation when the notes mature. So the credit quality of the bank is very important. Whether you're going to buy a note that's issued by one of the safest banks, maybe like the Royal Bank of Canada, or would you buy a note from a lower quality bank? The difference being, with a safer bank, you feel more secure about what you're going to get when the note matures. However, they do not have to offer as high of terms as a lower credit quality bank may offer. So if you're wanting to get more bang for your buck, some structured notes issued by some lower quality banks will offer better rewards or more protection, or maybe more protection. But you also have to be careful of that, because you want to make sure that when these notes mature in 3 years, 5 years, 7 years, whatever the case may be, you want to make sure that bank's still going to be around then. The last point on this slide talks about FDIC insurance. It sounds great to be able to get FDIC insurance on a note. However, those notes tend to offer very limited upside. So be very careful if you're looking at a note that has the FDIC insurance, because more than likely the return characteristics are going to resemble more of a safe bond. You're not going to have the upside that you might think you have as you would by investing in a stock-like investment. Stated maturities. Structured notes do have stated maturities so that you know when they are going to mature and when payment is going to be made. Typically, the longer the maturity, the better the terms that notes can offer. The shorter the maturity, you're not going to be able to get as attractive of terms. But just like many investments in the investing world, when you give up liquidity, you expect something in return. So if you're going to give up liquidity for 7 years, you want to be rewarded for that. Some notes do have call features. A call feature means that if certain things happen, the bank can call the note back and then make good on their payment at that time. Typically, we would avoid call features, but if you're being compensated enough for them, then sometimes it can make sense. Structured notes do have various risk and reward parameters. I mentioned earlier that notes really offer you a way to amplify maybe the upside, or maybe add some downside protection, maybe a little bit of both. We've used notes that do amplify the upside. One note we used was a short-term note, and it offered 300% of the gain of the S&P 500. If you're going for that much upside, though, you're not going to get any downside protection. We've also used notes that offer full principal protection, so very significant downside protection. When you use those types of notes, the opportunities of really great returns on the upside, though, are very limited. Oftentimes you want to use a combination where you get some amplification on the upside, some protection on the downside, and so we've also used a note where we get a little bit more than 1-for-1 of the gain in the S&P 500, but we also get a little bit of downside protection as well. And really it's like this slide says, if you want significant upside participation, you're not going to get any downside protection, and vice versa. So you want to mix and match maybe. That's what we do to look at where is the market at, what kind of protection are we wanting, or are we wanting just significantly more participation, and that's how we go about structuring some notes. Some of the risks and trade-offs. There certainly is reduced liquidity. If you're going to invest money in a structured note, please be sure that money can stay invested until the end of the term. So if it's a 5-year structured note, have no plans to be able to access that money for 5 years, and you're better off for it. It doesn't mean you cannot sell the note. If you need to, you can, but what is not guaranteed is what kind of price you can get for that note. You may have to take a few percentage points less of the value in order to get access to that liquidity. Many structured notes do not pay any dividends or make any interest payments. So if you're looking at these for cash flow purposes, maybe to increase your income, most structured notes are not going to do that. Some of them do, however, pay interest payments, but then you're getting into some more complex notes, and many of the ones that we have seen aren't worthwhile. And the big risk here is the guarantee is only as good as the guarantor. And people who held structured notes that were issued by Lehman Brothers learned a very hard lesson. And that is, if your note is backed by a bank and that bank goes under, you're getting in line with all the other creditors, and you're probably looking at receiving pennies on the dollar. So before you buy into a structured note, you want to do the credit research and really understand that the bank is in very sound standing and that they're going to be able to make good on their obligation when that note matures. Always know what the tax considerations are before you buy into a structured note, because different structured notes have different tax consequences. Sometimes when they mature, the gains can be recognized as income. Sometimes the gains can be recognized as capital gains. There's a big difference between how those two categories are taxed. Some of the notes that offer significant principal protection actually have a taxable event every year. So if you own a 5-year note with full principal protection, you're probably going to have to recognize some taxable income year by year until maturity, and then when the note matures, then you'll have to do kind of a settling up where you look at how much taxable income was recognized at the end of the term, how much should have been recognized, and you make up the difference. But it is important to understand what the taxable consequences are, and then once you understand that, that might help you decide where the note should be held, what kind of an account, whether it's a tax-deferred account, a tax-sheltered account like an IRA, or maybe an after-tax account, because the tax consequences are pretty friendly. The toughest part about looking at a structured note probably has to do with the expenses, because you often don't see what the expenses are when banks are structuring the notes and creating them for you. They're taking their cut out of it, but they're not necessarily saying here's exactly what you're paying for the expenses. Now we do ask the banks that we use what their expenses are so that we can get a good understanding of whether we're getting a good deal or not, whether it's too expensive, and we can also use that to compare with other banks. So we do a lot of comparison shopping when we're doing structured notes. But the way expenses work, the higher the expenses, the less attractive the terms the note will offer. And an example might be if you're investing in an S&P 500 note and you think you're going to get 150% of the upside. That may be the case with a relatively inexpensive note, but if you go to a bank where they're charging higher fees, you may only get 125% of the upside. So the costs do get reflected in the terms of the note, and it's a good idea to be able to compare several different notes issued by different banks to really understand what the best terms that would be available for you could be. On average, the notes that we've been using have annual expenses between 0.4% and 1%. The 1% note was for a year-and-a-half note, so it was a very short-term note. We didn't have as long of a term to spread the fixed costs over, whereas the 0.4% I believe was for a 7-year note, so we had a much longer time frame to spread out the expenses, so on an average annualized basis they became even more reasonable. When you compare the 0.4% and the 1% to other investment alternatives, they're pretty in line with some of the cheaper competition. So if you're looking at mutual funds, an international fund, a small cap fund, they usually have expenses that are well over 1%. Index funds are going to be cheaper, but certainly 0.4% and 1% for an investment product is within a reasonable range. This slide looks at an actual note that we've purchased for our clients, and it kind of demonstrates the risk and the return potential for this note. So this note is tied to the Dow Jones Industrial Average, and it's a fully principal protected note. And on this graph, if you look at the blue line, on the left side of the graph, it's horizontal. And that's telling you that no matter how much money the Dow loses, we get that principal protection so that upon maturity, our $100 investment is still worth $100. Now, if over the term of this investment the Dow Jones increases in value, this note does have a 1-for-1 participation. So as the Dow goes up 10%, 20%, 30%, the structured note is also going up. And there's no ceiling or no maximum return that we can earn on this. So it's nice to see that when that protection kicks in that it's there, but also if the market's going to head higher, we're going to head higher with it. I mentioned earlier there are no dividends paid generally on structured notes, and that is the case here. So if you did own the Dow Jones outright and you held each of the 30 stocks in the Dow, you're going to get a dividend yield probably 2.5%, 3% maybe. Whereas with the structured note, you're not getting dividends. So you are foregoing the dividend, but in return you're getting the nice principal protection. This next slide kind of kicks it up a notch, where we have a little bit of downside protection, but more upside participation. And this is a note that we've used for clients as well, and this one is tied to the Russell 2000. The Russell 2000 is an index of 2,000 small companies that are publicly traded in the U.S. stock exchanges, and this is looking at the return characteristics of the note versus the Russell 2000. So the dashed line is the Russell 2000. So you can see if you start in the middle of the graph, if you go left, that means the Russell is losing value. If you go to the right, up and to the right, that means the Russell is gaining value. The structured note, however, is going to have a different payoff. It's not a 1-for-1 payoff. There is a little bit of protection that occurs if the Russell 2000 loses 10% or less, and if that is the case, then we have full principal protection. So the Russell loses 10%, we get all of our initial investment back. If the Russell loses more than 10%, then we're basically matching the loss of the Russell, and so there's no downside protection at that point. So there's a little bit of protection, but that's not really why we recommended this note. It's the upside, the additional return that we're getting, the amplification. That is the reason why we recommended this note. So in this case, we're getting 2 times the return of the Russell if it produces a positive return up until a maximum. So the maximum return is at 65%. So once the investment value goes from 100 up to 165, that's when you see it going to the right and leveling off and going horizontal there. If we were to extend this graph further, and if the Russell went up 70, 75, 80%, our note is going to continue to be horizontal, and so that's when we start to underperform the index, but only after the index goes up 65%, and in this case in a 3-year period. We don't think it's likely that small cap stocks are going to go up that much. Back in February they hit an all-time high, so to expect them to continue to increase at a significant pace we think is a little too optimistic. What we think is a little bit more likely is that small cap stocks are probably going to underperform the broader stock market. So if we are able to get 2 times whatever small cap stocks get, we're probably going to be happy with that. So if small cap stocks were to get only 4 to 5% a year over the next 3 years, we would be looking at an 8 to 10% a year return, which probably would be much more competitive with the broader stock market. So we think it's a good way to amplify small cap returns on the upside. If we're wrong and small cap stocks go down, we're going to perform probably similar to the index. So we're not really losing anything there. So hopefully those 2 examples give you a good idea of some actual real life notes that can be out there, and maybe some of the good characteristics that you can find in structured notes. And hopefully some of the other information that we've talked about has been helpful. If you have any questions or if you'd like to discuss this further, please feel free to give us a call. Our phone number is 317-843-1358. We do have a toll-free number, and the toll-free number is 1-888-843-1358. Or feel free to email me. My email address is bwendling@bedelfinancial.com. Thank you for your time.